Treasury announces increased sizes of nominal long and liquidity support buybacks. I think the first blush response that I was seeing that I kind of even thought was, well, this sounds a lot like yield curve control. I think, Matt, you've definitely got a more nuanced take here. But I'm curious your thoughts on why this is important, how this actually connects to your broader theme here of that U.S.-Canada negotiation.
Yeah, so I think if you are just viewing this as a US centric story, obviously we also just crossed over the $40 trillion in debt mark. Um, if you want to frame this in the sense as, hey, you've got a borrower who needs to control, rein in their situation the best they can, all of that, you can definitely just take that as a surface level story. But I think you're going to be missing the key details and actions going on uh, below the water level, and seeing the actual action that's fundamentally the important thing going on behind the scenes, right?
Yeah.
Um, so let's just start with this. All right, we know, Cameron, the Treasury came in, and I don't know that they actually put out any hard numbers.
It
They
was
like
just he threw out 4 billion, but it wasn't like we're gonna do a certain schedule or anything. It's just probably about that number.
yeah, so he's just like, we're going to do the buybacks. Yeah, okay. So, all right, start with this, right? You've got a bunch of longer term Treasury bonds, so 10 years, 20 years, 30 years, like they have some duration on them. Everything or issued basically since 2008 has a lower coupon than the market currently requires, right, to maintain par. This is where you see the handy posters who send you, oh, this is the highest yield since 2008 or 2007. It's like, all right, then it's not useful
Yeah.
information. It's just, you'll
Thanks for
see
letting
it.
me know. Yes.
Yeah. Um, so all of the issuance on the longer duration 10-year, 20-year, 30-year maturity bonds post 2008, those are sitting, by definition, at a lower coupon below than current market, and hence they're trading below par. Now, what the Treasury is saying here is, hey, we can step in. Hey, if we need to come in and support the long end yields of the United States Treasury curve, we have that ammo built up, and the ammo is sitting with the investment funds who make up the largest buyer of that longer term treasury debt, and we'll get into that in a slide in a second. But think of that as like a finite supply of fuel. And when I say fuel, like ammo might be a better word. Your opposition in this business negotiation, like they're going to fire at you. And one of the things they're going to do is sell their treasuries. So think about the treasuries as ammo, like Canada, Caymans, whoever, wherever these are located, their investment funds, if they want to attack Scott Bessent through the long end of the yield curve. And by the way, like most of the funding for the government, like the new funding, it's not even coming from the long end anyway. We know that those yields are going to have to rise. It's just a matter of how long, how fast, right? Do you take or do you absorb the impact, right? It's also everybody's yield curves though in the post-war Western coalition, like UK, Germany, France, Japan, with Canada in there. Everybody's yields are at the high end of their 52-week range. They're, even dating back to 2022 when the yields started to rise. We got out of QE, we got out of ZIRP. Everybody except for China and Switzerland, like long end yield curves are coming under pressure, right? So it's everybody. My point here, the goal here isn't to, defeat everybody. You don't have to spend all your ammo and be the last man standing, like playing offense. You like same thing as the global growth slowdown. Eventually, someone is gonna run into that brick wall, and you just need to outlast your competitor, right? And so with Scott Bessent here, what he's saying with these buybacks, we've got that stockpile of below par long-term bonds that are out there, right? And most of them are held by investment funds. Most people would think that end of the yoke, it's the Fed, right? QE, they've acquired all of it. No, it's like
Right.
Fed's a small, they're about 10%. We'll get into that slide. We just move there in a sec. Let's just do it, Cameron. Let's get on that slide. Um,
Yeah.
but basically, what Scott Bessent is saying is like, I can defend my yield curve. I have this ammo or this fuel to push back, and if you want to come at me, we can fight through the night if you want. We're going to be here standing in the morning. So like, if you want to shoot that, try to attack us through the long end. Um, whatever, attack the Treasury through its financing mechanism. Um, it's really a show of force. So like you can see this here. I got the 10-year, 20-year, 30-year stacked up, like think of them in rows. This is from the Treasury report where they break down um, the buyer composition at the Treasury auctions by their category. So you list, say, the Federal Reserve or the SOMA facility, depository institutions, aka banks, credit unions, etc., individuals, family offices, uh, broker dealers, pensions and retirements, and insurance companies, investment funds, foreign and international, and then other. Now, notice investment fund, that would be like your PIMCO bond fund or something like that. A lot of these other categories, so you might have a state pension who hires an investment manager to run their bond portfolio. If the assets are titled or held in an ETF or held in a mutual fund, and your pension is getting its exposure to treasury bonds or dollar credit through these funds, it's going to show up in the investment fund category, right? My point here, if you look on the right, um, the investment funds are your largest owner. They're your big buyer at auctions, and I've got three groupings here. Number one is the trailing 12 months. This would be August 2025 through July 2026. And then the year prior to that. And then the 3-year average or the annual average of the 3 years prior to that prior year. So it doesn't line up with any calendar year, but if you just think about it, it's the trailing 5 years, average of the first three, the fourth one, and then the most recent one. All right. So what you'll see here, the step up since as we exited the QE and ZERP era in 2022, you see like two things that I'll call out here. Number one, the Fed has pulled back. Like the Fed isn't monetizing the long end of the yield curve anymore. The the duty to price yields, absorb the long end issuance of the bonds. It's been shifted over the trailing 5 years coming out of COVID onto the investment funds. So if you look at the 10-year, right, you've went from a $270 billion issuance absorbed by investment funds up to right at like 328 billion. So up $57 billion in the last 2 years. Uh, that's actually, if you look at the growth of the 10-year issuance for the Treasury, total of 42 billion in growth, 57 billion dollars or more than the total growth has been absorbed by investment fund, right? And it's the 20-year is a little bit different. It's a unique animal. It's a recent launch. I won't get into that one. The capacity there has actually declined since COVID as we've come out of the QE ZERP era. 30 years though, it's the same trend. Investment funds have increased their takedown at these auctions by $22 billion annually, which is more than the total increase in that 30-year issuance of $16 billion. Like of the last 12 months versus the average of the of each year at the beginning 3 years of that 5-year look back window. So my point here, when you see like yields start to sell off, right? It's really your marginal buyer is investment funds or are investment funds, like to get my conjugations correct. And what we're saying here, so when think about this, if you go back and look at the tick report, we won't see this for another 2-3 months, but you can see it in earlier this year when Canada is selling or Caymans are selling, they're Bank of England is selling. They are putting pressure in secondary markets on those yields, forcing yields higher. It's actually forcing everybody's yields higher. As we've shown in the WB chart. from Bloomberg on prior episodes. But think about that. So can't like say like Bank of Canada or Mark Carney says like, hey, negotiating process. Let's strengthen our position by selling some of our treasuries. Or there's this other situation with Japan, right? We talked about the intervention. We're going to use the FEMA facility so that Japan doesn't have to dump long-term treasury capacity on the market. Um, my point there, there's going to be secondary market like selling taking place. The investment funds only have so much capacity that they can buy in markets, right? Um, 60/40 funds, right? If the equities pump, the 40% gets rebalanced. That creates more
Yeah.
domestic capacity to buy more treasury bonds, et cetera. Tells you why the administration is supportive of an equity bull market. Um, but if you think about what Bessent is doing, he's saying, no, 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 we have this stopgap and it's finite. We can't do this forever, but we can buy these sub coupons like below par um, uh, treasury, like long-term treasury bonds that we issued post GFC through 2022, 2023, somewhere around there when yields were below what they are right now on the 10, 20, and 30 year.
Right.
We can pull those out of the market, and then that arms the investment funds, or that supplies them with cash, and then they can go sop up that excess at these yield levels that say Mark Carney or whoever would be aligned with him in this negotiation uh, wants to sell. So that's the interesting development here. But if you think about this as just, hey, it's QE, it's YCC, um, there's a lot more behind this. Um, I think if you just view this as like the debt is going to go up, to infinity, the dollar's dead, all of that, it's like, yeah, I think it's quite a bit more complicated than that framing. All right.
So how do we get a better handle on kind of who has the upper hand and kind of what's going on right now then?
All right. So this is where we're going to look to market pricing and the headlines. Great question, Cameron. Obviously, we've got a thesis. We try to update, those priors as the material developments come in. But one of the things like I thought of to watch this week um, that could be an interesting signal on where things are going. So no. All right, so what I've got posted here, I've got Brookfield's stock price on the white line. It's you know Canadian equity benchmark, the Toronto Stock Exchange TSX index in orange, and then in yellow we've got the Toronto Stock Exchange composite financial sector, which would be Brookfield's peer group, right? Your Royal Bank of Canada, your TD, et cetera. Um, so if you look at this divergence that's opened up since Epic Fury, commenced on February 28th, I think there's an interesting tell here. Obviously, like if you zoom out on the chart of Brookfield, it's up and to the right, right? Turns out it's good to own the the business an equity stake in the business franchise that has a seat at the high table, right? Who would have guessed?
Right.
But if you looked at like the developments of 2026 and what's going on, and this has been like an important year. Like it'll go down on the historical record as um, this what do you call it, broader conflict, collision, renegotiation of the post World War II order takes place. Um, you'll see this underperformance materializing, and like I said, like the returns on Brookfield historically, they're great, right? You've outperformed the market but like the TSX by a massive margin, but that those jaws opening up since Epic Fury started on Feb 28th, and then the widening since then. You see the squiggles on the lines. I'm not going to do any crayon technical analysis, but that white line is trending down. Orange line for the um, TSX itself is still bullish, trending up, and then its peer group in yellow like are
Takes
very
off.
like
Yeah.
going, yeah, very very strong. Um, I find that interesting, right? So if Brookfield, if the large stakeholders were bullish on the prospects as this U.S. Canada trade negotiation is working out, and it's so important that something like there will be a deal. Um, you would see buying from the insider stakeholders driving up. Like we pulled up the chart here of HSBC or JP Morgan. Like those look insane. Like those charts are like some of the strongest bull trends in financials. Like you like charts you can pull up. Brookfield, this is interesting. So what we're gonna do, we're gonna wait and see. Um, there's going to be a trade deal announced, or they can just keep kicking the can down the road. Um, but yeah, when it happens, we'll look to these market signals to guide us or to give an assessment of who got the upper hand. And one big tell will be whether or not we see Canada enter the Pax Silica